So I'm Michael Miller, and I did dynamic portfolio allocation. I'm excited to share with you today a method to provide an answer to the question that will help multi-strat hedge funds answer the question, how do they allocate their limited funds among their well-performing strategies? This is an extremely important question to a multi-strat hedge fund, often overshadowed by the development of their individual alpha strategies. Not all strategies work at all times of the year or under different regimes, and so it is important to be able to move funds among the strategies in order to capture their best performing moments. But this can be complex. A strategy predicts trades to maximize capital gains. An allocation policy then predicts which of those strategies will predict the best trades compared to competing strategies in the portfolio. So a prediction on a prediction. As you would imagine, that can lead to lost information along with competing strategies and compounding decisions in a chain of decision making. But sometimes a simple and elegant solution will work just fine. To provide a quick explanation of the constraints around our project here, we have the portfolio characteristics. Here are the constraints and characteristics of the strategies data that we were provided by AlphaCube. These strategies trade futures in Euro USD and GBP USD in both long and short positions. These strategies are also essentially going to have one trade at a single moment. And we used about 2.5 years of history with a resolution of hourly data. Each transaction has 0.7 bips on the base amount, and slippage is implied since we are using real trade history. So since there's only about one trade open at a time per strategy, you'll have on average 10,000 to 20,000 of base currency on your holdings at a given moment per strategy. Here is just a quick example of the strategy profit and loss. Most strategies were not super profitable, as most multi-strat hedge funds will have some clear winners that achieve sharps of, say, 6x or plus, while most other ones are only momentarily effective. So in this study, we took to link long-term projections of future returns for the strategies with predictors that we can attain only before and up to the rebalancing date. Real-world expenses and contradictions between the strategy's decisions and the rebalancing decision are considered to reduce the backtesting results and provide a realistic trading environment. Outside the typical trading execution costs and slippage, we considered how a rebalancing event to exit out of a certain strategy will trigger that strategy to liquidate positions at the rebalancing date. The difference between when a strategy wants to exit the position and when a rebalancing event decides the strategy is no longer an optimal allocation creates realized gain loss, and this on average creates an opportunity loss on the rebalancing date. So how does this affect your decision making? Well, if a single rebalancing event can cause a loss, then the more rebalancing events per year, the worse the model will perform. Ultimately, the key elements in this study show a couple aspects. Underlying asset signals are important to predicting how strategies will perform. And secondly, static or long-term features are important to mix with more dynamic and short-term features. The balance of this is crucial to make sure that the model is grounded in the larger performance picture of the asset type and strategy methodology, while also being able to adapt quickly. So here we have our first features, strategy performance metrics, typical Sharpe ratio, information ratio, drawdown recovery time, and your risk characteristics, such as the standard deviation of returns and momentum. So When training and testing, we looked through nearly a dozen machine learning models to understand which models perform best. And essentially, we came to a few that have outsized returns. So the other features are your typical classification or confusion statistics. Essentially, here you're looking at whether or not how often a trade is successful in each increment of time. And then you're also looking at the magnitude in terms of how large that gain or loss was in that moment. We also looked at the underlying technical signals. Here you're looking at, but not limited to, your MACD, your Bollinger Bands, which create signals, and those signals are what we're going to use then to see whether or not there's going to be a breakout in the price or a reversal. Here we're also showing the simple moving averages, the exponential moving averages, and the relative strength index. Typical of the RSI is if it is relative to 70 or 30. Here we're using 60 or 40 since the EURUSD and the GBP USD are very conservative in terms of their movements. And here are some other technical signals. We use volume-based indicators, stochastic oscillators, and money flow indicators. So moving on to the evaluation, as we were discussing before, static and dynamic features are present, and we need to have a combination of both in order to capture both the long-term performance of these strategies and be able to also adapt quickly to short-term momentum. So when training and testing, we wanted to make sure that there's no look-ahead bias or information leakage from one period to the next. And so careful implementation using the walk-forward validation was used. Here you can see what we do is we train for 1 year and then validate for the month going forward, and then it predicts the outcomes after that. So it will rebalance on a monthly date and predict for the entire month leading up to that with no information past that point. And then the machine learning algorithms that we used that came out with good returns were the multi-layer perceptron regressor, which is a neural network, the stochastic gradient descent regressor, and the adaptive boosting regressor, which is a kind of an ensemble model. So we wanted to compare this to several benchmarks. Here, what you're simply looking at is a Monte Carlo simulation that took 1,000 simulations of picking the top 10 strategies on a monthly basis. And you can see the simulation spread and the average, as well as just simply taking the previous top 10 performers and rolling those forward each month. And as we know, past returns are not good at creating future returns, as we can see here. And then finally, we have our results. Here, what you can see is the top and bottom are the best case scenario and the worst case scenario based on the available strategies that were provided by AlphaCube. And then the 3 lines in the middle are our machine learning models that predicted the returns on a rebalancing. So what you can see here is that we have very little drawdown. They're very consistent over time. They nearly reach the optimal line, yet without overperforming. And at the same time, they perform well in this beginning period. As you can see back at the benchmarks, the first half of this time period, the market in general did not do well. And yet, in the second half, it did. So anyone can do well when the market's doing well. But in our situation, we're doing well consistently over time. And this will help any type of strategy or multi-strat hedge fund properly allocate and create consistent returns, which are great for investors. And that's really